Okay, Andrew, well, it's a great pleasure to meet you. You're Andrew Ellis. You published the European SPIVA report. So let's just say what it stands for.
So it's the S&P Index versus Active SPIVA scorecard.
So it's S&P Index versus Active scorecard. So tell me why you create a scorecard and what an active fund is.
So the SPIVA scorecard measures the performance of actively managed funds against the respective benchmark. So a benchmark being a broader measure of the performance of the equity market.
Okay, so let's say I'm a fund manager and my job is to do what?
So a fund manager, obviously the primary objective is to outperform a benchmark.
Okay, so let's say my benchmark was the FTSE 100 and the FTSE 100 goes up by 10% in a year.
Yeah.
What would be expected of me?
So you would be hoping to achieve returns in excess of 10%.
Okay. But if I just tracked that 10%, if I just had a dumb fund which just tracks the benchmark, that would be very cheap to do, presumably.
Yeah, so there are passive index-linked products in the ETF space which have typically much lower fees.
So I think some of them you just pay like 0.07% per year. So if you invest £100, you just pay, I think, 7 pence per year.
Yeah, so there is this bigger difference between the fees charged in the passive space and the active management space. So the SPIVA scorecard is there to just highlight and provide and contribute to that debate to show what the performance of these active managers is with regards to their respective benchmark.
So it really adds value because there's been this massive debate about whether people can actually consistently beat the market. So that's been the big question.
Yeah, and that's why we show the analysis over multiple time periods, starting at 1 year, and depending on the region, up to 10, 15 years, to show what proportion of funds are outperforming over those longer term horizons.
Okay, so I think some people also call this alpha, don't they? It's how much you can outperform the benchmark.
Exactly. So alpha is the outperformance, and beta is kind of your portfolio sensitivity to just the general market performance.
An alpha would be expensive because it requires real skill to choose the stocks which will beat the market.
Yeah, so that's the theory, that investor skill can lead to outperformance, and we're just providing information to help inform people in that debate.
Okay, so I think the European SPIVA report has only been around for 4 years, but it obviously looks back over a longer period because you have data which extends back in time. The US one has been around for 15 years.
Yep. So we have 15 years of data in the US, we currently have 10 years of history for the European SPIVA.
I guess the next question is, how well have active funds performed globally?
Well, in general, if we look across all the regions and countries and just look at like recurring themes that we see, in general we see that the majority of actively managed funds across any category is always typically underperforming the benchmark, whether that's over the short term or long term. But when we do see a particular category that may be outperforming, it's usually not seen in multiple periods. So if they are outperforming for one particular time frame, maybe the most recent year, then we don't see that occurring over 5 and 10 years. So the most recent SPIVA scorecards for US and Europe are actually a good example of this, because we saw some improvements in the active manager performance. But the longer term picture just remained unaffected. We see the same high proportion of funds underperforming over 5 and 10 years.
So quite disappointing globally. But you do have pockets, you do have variation across different regions, don't you?
Yeah, exactly. So over the short term, it may be relatively easy to outperform, given, say, recently we've had a risk-on environment, so maybe size, small cap stocks have outperformed. So any funds that are exposed to that smaller size, so less exposed to larger cap companies, may have found it easy to outperform.
Okay, so let's just unwrap that a little bit. So during one of these market rallies, when everybody is buying stocks, there's some people have described it as animal spirits abounding. So lots of people are willing to take risk, and they buy stocks, and the stock markets rally. So things which are more risky tend to perform well in that environment, like small cap stocks,
exactly,
like little companies.
So in particular in the UK, we do see this correlation when risk on and size is doing well. We see the actively managed funds in the UK also performing very well. But it's just a short-term thing that we see. We don't see it persistently outperforming. So it's very difficult to time your exposure and allocations to these particular styles that are doing well in the short term, it's very difficult to do the same over longer time periods. So it's difficult to allocate correctly.
Now let's just play devil's advocate for a minute. So let's say that there was a fund manager which just randomly allocated, or just took one of these styles and ran with it. They may perform well during one certain period, like you're saying, but over the long term, like a whole business cycle, which is usually about a decade, they wouldn't perform well consistently. That's what we're saying.
Well, we're not saying it's. We're saying when we look at all funds combined together, we see that the majority of funds don't do well. Whether certain funds can do that, then that's obviously possible, but we're looking at the bigger picture.
Okay. So for an investor, I think the difficulty is finding the funds that outperform. So do you have any advice for how to choose funds which are going to outperform in the future, given the results of your scorecard?
No, that's not something that we would provide information on. We're just trying to show you the numbers, let market participants use those to help justify whether or not active managed fees are worth the cost that they pay. We just let the numbers do the talking.
One of the things in the US is that it's a very efficient market. In other words, the market instantly prices in any new available information, whereas markets which are less efficient, in theory, should be better for stock pickers. Can you talk a little bit about that and why it might be the case?
Yeah, so the theory is in the smaller markets where maybe there's less volume, stocks may not be priced at their fair value, so there may be more opportunity to outperform. So information, analysis could actually give investors an edge. But as a theory, we're not able to conclusively prove whether that's the case or not with the SPIVA scorecard, because we kind of see mixed messages. For instance, in the UK, as I mentioned, that category in general does particularly well compared to others.
The small cap one?
Yeah, the small cap. And we believe that may be because of this less efficient market theory, that there's a larger opportunity set, more scope for discovery. But in contrast, when we look at the emerging market equity funds, again in the Europe SPIVA scorecard, we see that that's actually one of the worst performing categories, and it has consistently been one of the worst performing categories. Whereas if you believe the less efficient markets would lead to extra alpha, then you would expect that category to do well, and we're just not seeing that.
Okay, so it doesn't really seem to be panning out, but less efficient markets are generating more.
The message is definitely mixed.
Okay, so some people have said that a fairer comparison for S&P to do would be to compare active funds versus passive funds. So let's say we had a stock picker for the FTSE 100. They would be compared versus the trackers for the FTSE 100, because that would also include the fees that you get for the average FTSE tracker. Mm-hmm. Would that be a more fair comparison, or why don't you do that?
I understand the point. The issue is that obviously we're an index calculation agent, and the fees that are charged on these passive ETFs are entirely down to that ETF provider. Yeah. So we're not responsible for that, and we can't advocate certain funds or passive funds over others. So we just wish to show the active managed performance with respect to their benchmark, because ultimately that gives investors enough information. If those active funds are trying to outperform a benchmark, we're just providing that information.
So that's their job, right, to beat the benchmark, and so you're neutral on, you want to remain neutral. That's part of the reason. Okay.
And also, as already said, the fees that are charged on passive ETF products are obviously typically much lower as well.
Okay. So if I wanted to tell whether it was skill or luck which made people outperform, now I'd be willing to pay for skill. I wouldn't be willing to pay extra to an active fund manager if they're just lucky. But if I want to discriminate between those two, presumably I'd look over a longer horizon. So I'd look over 1 year, that would be fairly volatile. Then I'd look over 2 years, 5 years, maybe even 10 years to see which managers are the best. So could you talk a little bit about what it looks like, your results, when you look over a longer horizon?
Yeah, so I can quote some figures from the recent SPIVA. So we had results in mid-2017. So in Europe, so pan-European equities, actively managed funds, we saw around 51% underperformed. So that was a particularly good year for active managers.
And that's in a single year?
Yeah, this is the most recent year.
So it's 50-50?
Yeah, pretty much 50-50. And still, that's one of the better performing years But when we go to a 10-year horizon, the number increases to 87%.
So 87% of the funds are underperforming their benchmark. In other words, not doing what they're paid to do.
Yeah, exactly. And the same picture is true in the US. Again, a relatively good year, only 56% of funds underperformed over the 1 year period.
So worse than the UK.
That's US large cap. Yeah, slightly worse than the UK. And that figure increases to 85% over 10 years.
That's pretty shocking, isn't it? Only 15% of the people that actively manage funds outperform the benchmark.
Yeah.
Okay, over the long term. So that kind of suggests that it's luck rather than skill which is driving the performance.
Well, it's not our position to say that. Let others make that decision.
Be consistent with that. So one of the great things that you have in the US is, as well as the SPIVA, which measures performance of funds versus the benchmark, percentage that outperform over different horizons, you also have this persistence scorecard. So why do you need that in the US, and what does it tell you that SPIVA doesn't?
Yeah, the persistence scorecard, as you say, is available in the US, and that's really trying to show the consistency of outperformance in consecutive periods.
So this is the luck versus skill.
Yeah, it's trying to really differentiate between luck versus investor skill. So if there is real investor skill, then they should be able to prove that they can be in that group of top performers persistently from one period to the next. So what we'll do is categorize all those funds in the top quartile, and then say what proportion of those are also in the top quartile the next period, and so on. And we see in the US that obviously relatively few funds can remain in that top performing quartile for multiple periods.
Some people I've seen have said that that's because it's a very efficient market. It's hugely overanalyzed, if you like. So it's so efficient it's hard to beat the index. Do you think that's a fair criticism?
Yeah, it's absolutely fair.
And then the size of that US mutual fund market is massive, isn't it? I think it's over $10 trillion, the mutual fund industry in the US.
Yeah, so it's a very large market, and obviously there are passive index-linked ETF products that will provide exposure to that market without the typically high active management fees associated with it as well.
Yeah, so for example, Vanguard will track the S&P 500 for 0.07% per year. Yeah. Okay. So it's very difficult to compete with that, as Warren Buffett has pointed out recently.
Absolutely.
Yeah. One of the problems with tracking performance over time is survivorship bias. Could you just quickly explain what that is?
Yeah, so during a period of analysis, there may be several funds which liquidate or merge, and those funds are not there at the end of the study. So if you only calculated the performance of a fund which survived at the end of the period, then you would actually be artificially inflating, because the funds that liquidated typically poor performance. So by not including those poor performing funds that don't survive to the end of the period, might look like the performance of active managers is actually greater than it is. So what we do in the SPIVA scorecard is actually include the entire opportunity set as of the beginning of the period. So include all those funds, whether or not they survive to the end.
So you wouldn't artificially inflate the performance?
No, so if a fund liquidates or merges at some point, will it still include their performance from the start of that period?
Okay, so if I buy an active fund, one of the problems is that it may not survive, because if it underperforms, they often liquidate the fund. Mm-hmm. So could you just give us a feel for the survivorship of funds in the UK?
Yeah, absolutely. So we saw that over the 1 year time horizon in the last Europe SPIVA scorecard for UK, for instance, that category saw that in 1 year 95% of funds would survive for that whole period. So those the funds that would be available at the beginning, with only 95% were there at the end. But then when we look at 10 year, we see that only 45% of funds that were actually in existence 10 years ago had survived now.
So a lot of these funds over a 10-year period, more than half of them just liquidate.
Yeah,
performance
could only assume. Yeah, that's just poor performance.
Okay, that is pretty shocking as well. Okay, so it's very difficult if you're an active investor, if you buy active funds, to firstly find a fund that you think will outperform, given its persistence is low over time, but also because survivorship is fairly low over a decade. So you may end up with a fund that no longer exists, and you have to reallocate your capital.
Yeah, the figures do show that it would be very difficult over a long time horizon to choose a fund which survives the entire period and outperforms over that entire period too.
Okay. Well, that's been really interesting. Thank you so much for your time, and thank you to S&P also for producing this really valuable report. Thank you, Andrew.